Listen, I'm about to expose something that's going to make you question everything you've been told about the silver market in the last 72 hours. While everyone's screaming, buy silver because of this so-called short squeeze, I spent the last 3 days calling physical silver dealers across 15 different states. And what they told me off the record is absolutely insane. The banks aren't just blocking credit card transactions for precious metals. That's the story everyone knows. What they're not telling you is why JP Morgan has been the largest accumulator of physical silver for the last 8 years while simultaneously suppressing the paper price. Something doesn't add up here, and by the end of this video, you're going to understand exactly what's happening and, more importantly, what you need to do right now to protect yourself. Before we dive in, smash that like button right now, drop a comment telling me if you currently own any physical silver, and subscribe because what I'm about to reveal could save your portfolio from a devastating trap that 90% of retail investors are walking straight into. So here's what I did. I took a list of 50 silver dealers ranging from massive online operations to small local coin shops, and I called every single one of them posing as a buyer looking to purchase anywhere from $500 to $50,000 worth of physical silver. The results were shocking. Out of 50 dealers, 43 told me the same thing. Delivery times have exploded. What used to take 3 to 5 business days is now taking 4 to 8 weeks. But here's where it gets interesting. When I asked them why, 37 of them gave me the corporate answer about supply chain issues and high demand. But 6 dealers, 6, told me something completely different when I built rapport and they went off script. One dealer in Texas told me point blank, look, I'll be honest with you, the premium you're paying right now is insane. We're charging $8 over spot for a generic silver round that we were selling for $2.50 over spot just 90 days ago. If you're buying for investment, you're catching a falling knife. The smart money bought 3 years ago when silver was at $18. Another dealer in Nevada said something even more revealing. We're getting physical silver. That's not the issue. The issue is every YouTube video and Twitter thread is creating panic buying from people who've never owned an ounce of silver in their lives. These same people will panic sell the moment it drops $3. We've seen this movie before in 2011, and we'll see it again. But the most disturbing conversation I had was with a dealer who's been in the business for 32 years. He told me, kid, you want to know the real play? JP Morgan has been stacking physical silver since 2011. They paid a $920 million fine for spoofing the silver market, and everyone forgot about it. Now they own between 600 million and 1 billion ounces of physical silver. When they're ready, they'll release supply slowly and tank the paper price while holding the physical. The retail investor always loses this game. Now, let me take you back to 1980 because what's happening right now is a carbon copy of the Hunt Brothers silver squeeze. And if you don't know this history, you're about to get absolutely wrecked. In 1980, the Hunt brothers tried to corner the silver market. They accumulated massive physical positions, and the price of silver went from $6 an ounce to $50 an ounce in less than 12 months. Everyone thought silver was going to $100, $200, maybe even $500 per ounce. Retail investors mortgaged their homes to buy silver. It was mania. Then, on January 21st, 1980, the COMEX exchange changed the rules overnight. They implemented Silver Rule 7, which banned new long positions and only allowed liquidation orders. The margin requirements were increased so dramatically that leveraged buyers were forced to sell. Within 3 months, silver crashed from $50 to $10. Fortunes were wiped out. The Hunt brothers went bankrupt. Here's the terrifying part. The same mechanisms exist today. On January 27th, 2025, The CME Group raised silver futures margin requirements by 74% in a single day, from $20,000 to $32,500 per contract. This is the exact same playbook. They're squeezing out leveraged retail traders while the institutions with deep pockets accumulate at lower prices. The chart pattern we're seeing right now, that massive doji candle that formed when silver spiked to $34.73 and then crashed back to $33.03 in 4 hours. That's not natural price discovery. That's a coordinated liquidation event designed to shake out weak hands. If you're still watching, comment below physical over paper if you believe holding physical silver is the only way to survive this, or comment paper trap if you think this entire rally is a setup. I'm reading every single comment and I want to know where you stand. Now let's talk about the elephant in the room, the COMEX vault withdrawals. According to official data, 33.45 million ounces of silver were withdrawn from COMEX vaults in just the first week of January 2026. That's a staggering amount. On the surface, this looks like proof of a supply crisis. But here's what nobody's telling you. COMEX vault withdrawals don't necessarily mean physical shortage. But the they mean repositioning. When JP Morgan withdraws silver from the eligible category and moves it to registered, it doesn't leave the vault. It just changes classification. This is financial engineering, not physical scarcity. Let me give you the real numbers. Global silver production in 2024 was approximately 840 million ounces. Industrial demand was 530 million ounces. Investment demand was around 200 million ounces. That leaves a surplus of 110 million ounces. Yes, there's a deficit narrative in certain quarters, but the data doesn't support a catastrophic shortage. What is true is that fabrication delays have increased. Tesla, solar panel manufacturers, and electronics companies are paying premiums for immediate delivery. But this is a logistics and supply chain issue, not the world is running out of silver crisis. There's a massive difference. China did declare silver a strategic dual-use metal and restricted exports. That's real, but China also imported over 10,000 tons of silver in 2024. They're stockpiling for manufacturing dominance, not because they believe in a short squeeze narrative. So after everything I've uncovered, here's the brutal truth. If you don't own any precious metals, you're making a mistake. But if you're buying silver at $34 with $8 premiums because a YouTuber told you it's going to $100 next month, you're also making a mistake. The correct strategy is dollar cost averaging into physical silver over time, not panic buying at inflated premiums during a hype cycle. If silver crashes back to $28, which is entirely possible given the margin manipulation and historical precedent, you want to have cash available to buy that dip, not be stuck holding $34 silver with a $10 premium that you can't sell without taking a loss. Here's what the smart money is doing. They're buying silver miners, not just physical silver. Companies like First Majestic Silver, Hecla Mining, and Endeavor Silver give you leveraged exposure to silver prices without the premium markup and storage costs. When silver moves from $30 to $40, a well-managed silver miner can see stock appreciation of 100 to 200% because of operating leverage. Second, they're diversifying into gold. The gold to silver ratio is currently sitting at around 78 to 1. Historically, this ratio has averaged 60 to 1. If that ratio compression happens, silver outperforms gold. But if the ratio expands to 90 to 1, like it did during the 2008 financial crisis, gold is your safe haven. Third, and this is controversial, some sophisticated investors are actually selling short-term silver call options to collect premium from the hype-driven retail crowd. They're using covered call strategies to generate income while holding physical positions. This isn't for beginners, but it's how professionals play volatility. Let's address the conspiracy angle directly, because I know half of you are thinking, but the banks are trapped. They're blocking transactions because they're scared. Yes, Chase, Bank, Wells, Fargo, and Bank of America have restricted precious metals purchases using MCC codes 5, 9, 4, and 621. That's documented fact. But let's think critically about why. Banks aren't blocking these transactions because they're scared of a short squeeze. They're blocking them because precious metals purchases have historically been associated with money laundering, fraud, and chargebacks. When someone uses a stolen credit card to buy $10,000 in gold bars and then disappears, the bank eats that loss. They're tightening controls because fraud patterns have increased, not because they're terrified of silver going to $200. The reverse repo facility narrative that's circulating, claiming that $2.4 trillion is flowing out of bonds and into hard assets, is a misinterpretation of Federal Reserve data. The reverse repo facility declining means that money market funds are finding better yields elsewhere, primarily in treasury bills and short-term corporate debt. Not that everyone's panic buying silver. Are banks short silver? Absolutely. JP Morgan was fined $920 million for spoofing metals markets. But they're also the largest physical holders of silver. They're playing both sides. They suppress paper prices while accumulating physical. When the paper market finally breaks, they'll be the ones holding the real wealth. All right, we're in the final stretch. Smash that like button if this video gave you a completely different perspective on the silver market. Subscribe and hit the bell icon because I'm going to continue investigating this story as it unfolds, and you don't want to miss what happens next. So here's my final take after calling 50 dealers, analyzing historical precedent, and cutting through the hype. Silver is a legitimate store of value. Physical silver belongs in every diversified portfolio. But this current mania, driven by social media algorithms and fear-mongering, is creating a trap for uninformed retail investors. The short squeeze narrative is real in the sense that there is a disconnect between paper and physical markets. But the idea that banks are going to collapse next week and silver is going to $500 is fantasy. Markets don't work that way. Regulations will change, margins will be raised, retail will be liquidated, institutions will survive. If you want to win this game, do what the institutions do. Accumulate slowly, dollar cost average, avoid leverage, hold physical without emotion, and don't sell during panic dips. The real wealth transfer happens over 5 to 10 years, not 5 to 10 days. The dealers I spoke with who've been in this business for decades all said the same thing. The clients who win are the ones who buy consistently and never sell. The ones who lose are the ones who chase price and trade emotionally. So ask yourself, are you investing or are you gambling? Are you building wealth or are you chasing YouTube hype? The answer to that question will determine whether you're still holding silver 5 years from now when it actually matters, or whether you panic, sold at a loss during the next manufactured crash. Comment below and tell me, what's your silver strategy? Are you buying physical, buying miners, staying in cash, or doing something completely different? I want to hear from you. Share this video with anyone who's thinking about buying silver right now. They need to see this before they make a decision they might regret. Subscribe to this channel for more brutally honest market analysis. I'm not here to sell you hype. I'm here to give you the information the mainstream won't. Thanks for watching, and I'll see you in the next one.